Welcome to the EDR brief. Today, we're cracking open the Q1 2026 10Q filing from Hudson Technologies, ticker symbol HDSN, and translating it into a plain English explainer. I've got a curious puzzle to hook you right out of the gate. How exactly does a company sell over $60 million in industrial refrigerant products in a single quarter, yet somehow $12.8 million in real cash just walks out the back door? Seriously, where'd it go? That is exactly what we're going to decode today. But real quick before we dive in, we are independent, not SEC affiliated, and absolutely not financial advisors. We use AI to help summarize these dense filings so, errors can happen. Always verify the numbers yourself on sec.gov before making any money decisions. Okay, part one, the business model. Let's figure out how Hudson actually makes their money. So before we can even look at the numbers, we need to know what they're actually selling. Think of Hudson Technologies as the ultimate recycling bin combined with a high-speed pit crew for commercial and industrial air conditioning. Like if a massive office building or a giant industrial processing plant has a huge cooling system, Hudson is the team supplying the gas that makes that air cold. The mechanics of their money-making machine are pretty straightforward. The vast majority of their revenue comes from one-time sales of refrigerants and industrial gases. But they also operate a highly regulated recycling business. They take used, sometimes pretty gross refrigerants from customers, clean them up, and sell them all over again. They also have a service arm called Refrigerant Side. Here, they basically act as specialized mechanics, decontaminating a customer's cooling system right on site to get it running at peak efficiency. As for where the money goes, well, it goes out to buy raw chemical gases, run those big reclamation facilities, and pay the specialized crews doing the heavy lifting. So basically, Hudson is a specialized chemical and logistics hub that makes its money by keeping America's industrial AC units running and compliant. Moving on to part two, the scorecard. Let's look at the Q1 2026 numbers that actually matter. First up, revenue. And the top line is actually growing. In the first quarter of 2025, they brought in $55.3 million. Fast forward to Q1 2026, and revenue hit $60.1 million. So more dollars are walking in the front door compared to the exact same time last year. Sounds like a total win, right? Well, here is the massive plot twist. Despite those higher sales, their actual accounting profit, what accountants like to call net income, completely fell off a cliff. Last year, they posted nearly $2.8 million in profit for the quarter. This year, just $330,000. I mean, how do you sell $5 million more in product, but watch your profit shrink to a tenth of what it was? To understand that, we have to strip down the cash flow statement. Because, as we always say around here, profit can be fiction, but cash isn't. Their accounting profit was $330,000, but their actual cash from operations, negative $12.8 million. That means the core business literally burned through nearly $13 million in real, hard cash. And the prime suspect for this massive drain, a negative $16.6 million swing in accounts receivable. Now, what does that actually mean? Look, accounts receivable is really just finance speak for IOUs. It's money owed to the company by customers who've already received the goods. Think of it like a restaurant that claims they had a record-breaking Friday night, but half the customers put their meals on a bar tab. Hudson delivered the goods to hit that $60 million revenue mark, but customers simply haven't paid $16.6 million of it yet. And that right there is exactly why the cash drain is so severe. All right, part three, the moat check. What exactly protects Hudson from the competition? So what protects Hudson from being completely crushed by a new competitor tomorrow? Well, their durable advantage is basically a toll booth on a highly regulated highway. You can't just wake up tomorrow, decide you want to start a refrigerant recycling business, and set it up in your garage. It requires massive, highly specialized infrastructure and complex environmental certifications just to handle these chemicals safely. That huge physical footprint and the government's regulatory blessing, yeah, that's not easily duplicated. And this really brilliantly illustrates the underlying tension in their business model. Their massive strength is securing these huge government logistics contracts, acting as the official supplier for giant entities. But their moat weakness is that they are ultimately selling a chemical commodity. If the global price of virgin hydrofluorocarbon gases drops, Hudson has to lower their prices too, no matter how amazing their infrastructure is. At the end of the day, they just don't control their raw material costs. Which brings us to part four, reading between the lines. How is management navigating all this? So digging into the commentary, three big themes jump out. First, they just spent $2.2 million in cash buying the assets of a company called Denver Refrigerants to expand their reach, and they're currently integrating that. Second, they are battling a brutal gross margin squeeze. While revenue went up to $60.1 million, their cost of sales shot up way faster, hitting $48.3 million. So for every single dollar sold, a lot less of it is sticking around to pay for rent, payroll, and ads. And third, they are sitting on an absolute mountain of inventory. We're talking $130.7 million worth of refrigerant just sitting in tanks. It's kind of like a giant warehouse stuffed to the brim with frozen goods, tying up all their capital while they just wait around for the summer cooling season to kick in. Let's move to part 5, red flags. What are the real risks here? Looking past all the standard legal boilerplate, the stuff lawyers write to cover asteroid strikes, the absolute loudest alarm bell in this filing revolves around customer concentration risk. This is what happens when a business operates kind of like a freelance writer who only has one major client. If that client decides to walk away, the whole business starves. Here's the deal. Hudson has a historic 5-year contract with the United States Defense Logistics Agency, or the DLA. In late 2025, Hudson was awarded the renewal for another 5 years. But, reading directly from the SEC filing, quote, a competitor filed a bid protest. The DLA rescinded the 2025 DLA contract award. End quote. Wow. So while the government reviews the protest, Hudson's shiny new contract has been pulled. They're still operating on the old contract for now, but that old one officially expires in July 2026. Just to really cement why this matters, the Defense Logistics Agency single-handedly accounted for $7.7 million of Hudson's revenue this quarter. That is nearly 13% of the entire company's sales tied up in one single, heavily disputed government contract. If they lose that protest, a massive chunk of their revenue literally disappears overnight. And finally, part 6, the bottom line. Let's wrap this up. Bringing it all together, the objective verdict here is that Hudson Technologies is a vital, niche industrial business protected by some pretty heavy regulations. But right now, they're battling rising raw material costs that are seriously squeezing their margins, and they are fighting tooth and nail to save a massive government contract that represents a huge chunk of their livelihood. So when the next SEC filing drops, here are the 3 specific things you need to track. Number 1, obviously the resolution of that DLA contract protest. Number 2, gross margin trends. Are their raw costs finally stabilizing compared to their sales prices? And number 3, the collection of those accounts receivable. Which leaves us with one final lingering question to ponder. With the clock ticking, will Hudson actually collect that $16.6 million in customer IOUs before their current guaranteed DLA contract runs out this summer? Well, that's your EDGAR brief on Hudson Technologies. Remember, this was just a translation, not a recommendation. Go read the original on sec.gov if anything here piqued your interest. Thanks so much for being with us at the EDGAR brief. We'll see you in the next filing.